Hello everyone, what a week we had. The market continued its meltdown as per my last video. If you have been following my videos or follow me on Moomoo platform, the sell-off shouldn't have caught you off guard, since I have already kind of pep talked viewers on the bearish market about a couple of months ago. Anyway, let's look forward. As usual, I will continue to share my thoughts on the market in this video and also offer some basic and layman technical analysis of a few mega cap stocks, which I believe most viewers can understand, so stay tuned to find out more. Okay, the stock market faced a huge sell-off and nosedive for a second consecutive week. In case you have not been following the news, the bloodbath is likely due to the Fed announcing a third straight 75 basis points interest rate hike. To share, this is one of the most aggressive campaigns to tighten monetary policy since the 1980s. To add fuel to the fire, it's not just US. Central banks around the world also raised interest rates last week to combat inflation. Such commitment to bring down inflation at all costs has worried investors, as it may cause high employment, high costs for businesses, slow economic growth, and a potential global recession. The US dollar, which tends to move opposite of the stock market, shot up to the moon last week as it hit a fresh two-decade high. The US dollar index, which measures the currency against a basket of foreign currencies, went on a massive run. And given the current rate, I wouldn't be surprised if it hits 120. Anyway, the latest sell-off has left S&P 500 near its lowest point of this year that was created in June, almost wiping out all the gains from the rally between June and August, which I previously had shared. That rally was a sentiment rally with false optimism from the investors that the worst was over. As we approach the end of the month, investors are now turning their attention to October as companies begin to report their Q3 earnings. In my view, investors should be mentally prepared that the earnings or forecasts by various companies will show further signs of weakening growth and demand. To also share, Goldman Sachs has recently lowered its year-end forecast for the S&P 500 by 16%. My personal take is that the current trend is bearish and I wouldn't fight the trend, just like Goldman Sachs, and I definitely will not fight the Fed. This means that even if there is a mini rally leading up to the earnings calls in October, it won't get me excited. Specifically for the upcoming week, some investors may view that the market is severely oversold in the last 2 weeks and it is due for a mini bounce, while others are convinced that we could have a third straight consecutive week of sell-off. For me, I'm not going to predict which way will the market go. As usual, I let the market go first, then I follow suit, and there is where some basic technical analysis can help. But before I move on to the technical analysis segment, I hope you can help me with the like and subscribe buttons and also leave a comment below. This is to show YouTube's algorithm that there are people watching my videos. Your little action will keep me going. Thank you. As usual, starting things off with SPY, aka the broader market. I have shared on several occasions that once SPY broke the crucial support level at 389, it could be ugly, and we could start to hit sub 370s or even 360. So this is one example how key support level works for the downside, and vice versa for resistance levels when the market is going up. Okay, so where do we go from here? Looking at the Fibonacci retracement level, the next support is definitely June's low at 360. Watch this level very carefully. If this is breached and SPY does not rebound quickly, we could have a landslide to 344. But a quick disclaimer, I'm not saying that it for sure will happen, it's all about probability. So yeah, bulls will want to defend this area to prevent a waterfall down. As I zoom out the chart, it appears to me that there is a bearish inverted cup and handle pattern. Just to share, cup and handle pattern is usually quite a powerful pattern, and if this turns out to be one, we could really waterfall down to at least the gap at around 350 area. On the upside, there is a gap at 370 to 373. So if the market is due for a rally, we could go up to fill this gap. This is where you need to observe to see if sellers will start stepping in. If they don't, there is a possibility that we will hit higher before hitting a huge resistance at 387. This is one crucial resistance as it coincides with the red dotted downward trend line. To put it very simply, as long as SPY is below 387 and the downward trend line, the market is very bearish. I wouldn't want to hold on to any call options. Okay, next Apple. If you have been following me, you would have known that I have been waiting for Apple to hit 145 and below since it was at 170s. And right now, we are not too far away from that price. Keep a lookout for 146 and 147. This is one critical support. If this breaks, not financial advice, but I think sub 140s would come into picture. I also wouldn't be surprised if it continues to slide towards the gap at 132 to 133. Again, nothing is guaranteed. So how key support level works is that once it is breached, it has a high probability of opening up a floodgate. But it does not always happen, alright? On the upside, the immediate resistance is 50% Fibonacci level at 152. This level, in my opinion, is a small resistance only, so no big deal if it breaks above. Apple needs to go above 158 and 160 to turn the table around temporarily. Do note that 160 is where the 50 and 200 moving average are currently converging, which will serve as a huge resistance. Interestingly, there was a hammer candlestick formed on last Friday, similar to the one we had 2 Fridays ago. To explain a little bit, this means that Apple's price got pushed down by the bears, but bulls managed to step in and push it back up to close the session near its opening price. And if we were to look at this candlestick by itself only, it is a slightly bullish signal. So perhaps we could have a small bounce early next week? Well, I could be wrong, as it could be market makers trying to cover their shorts on Friday due to option expiry. Moving on to Tesla, if you had watched my last 2 videos, you will know how I shared about Tesla getting rejected on 3 occasions when it went above the 200 moving average. And then it retested it for the 4th time and finally got rejected last week and went back down again. Anyway, as I zoom out the chart, to be honest, I don't see much support from this point to around 253 where the next support is. To add on, there is also a gap between 250 and 254. For Tesla to fall from the current price 275 to about 253, that is a good 20-point drop, and a total of about 50-point drop from 300-ish. It does sound a little crazy, but nothing is impossible. Alright, sharing my tentative plan here, but not financial advice of course. I may step in a little at around 260s range, just in case Tesla does not fall to sub 250s. But personally, I have been waiting for that 250-ish gap to be filled, so I will definitely reserve some bullets for it. It may or may not come, so be it. On the upside, we will just keep it simple. Resistance are at 285 and 300, which is the psychological level. And again, I'm gonna say that even if Tesla flies to 340, we are still in a downward trend, so don't need to be too excited. Now let's take a look at Microsoft. As a recap, I have stepped in at my first target price range, which is around low 240s and low 250s, as this is the lower end of the recent consolidation zone. But as I zoom out the chart, you will notice 2 blue lines that I have drawn many months ago. I can't even recall when. You can probably check out my videos about 3 or 4 months ago. Anyway, this is my second buy zone, ranging from 200 to 220s. Within this zone, there are 2 gaps waiting to be filled. They are 213 to 214 and 204 to 205. These are areas which one can consider to enter if Microsoft reaches here. On the upside, resistance is 270, so anything between 240 to 270 is just consolidation and nothing to be excited about. Next, Google. Just like Microsoft, Google has also created a new 52-week low. It is looking super bearish and it broke below a very critical support level, which is 100. Last Friday, I can see that bulls and buyers are stepping in, trying to bring Google back above it. The battle between bulls and bears for Google should likely carry into next week. So as mentioned, 100 is the next immediate resistance level, followed by 105. On the downside, if buyers get exhausted, we could slide all the way to 90, where the next support level is. And if that fails, wow, there are 2 gaps waiting for it at the bottom, between 82 and 84, as well as 79 to 80. I cannot imagine Google hitting this level. I will be so happy to load up even more shares as the valuation is simply irresistible. Some quick end thoughts here, 3 things to share in fact. First up, I would like to share my view of the current market again. Actually, nothing much has changed, and I have been emphasizing the same message over and over again. But I am just gonna reiterate this messaging for newer viewers, and that is, at this point I believe we are still in the period of short the pop or sell the rip season. Meaning to say, whenever there is a rally, traders or short-term investors can consider taking profits, because it is likely that these rallies won't last. I think I shared this about close to half a year ago, and my view remains the same. But again, this is not financial advice, okay? For longer term investors, I have also always shared about not to chase the raging bull during the rally or run up from June to August this year. Those who have chased it are likely trapped at the top. One best recent example is in my very last video where Tesla was sitting above $300, and I shared that the probability of Tesla going below 300 is higher than staying above, and that investors or traders can consider taking profits. And guess what? Tesla is currently at 275, a huge 25 points drop from 300-ish. And for long-term investors, isn't this a better price for you? Secondly, I also wanted to share that despite my bearish view of the stock market, I am still optimistic about its future. For long-term investors, I would think we should love a bear market because that is where we accumulate good company stocks at lower price points. The reasons for anyone not to like bear market is likely they have a short time horizon, or on the verge of retiring, or if you need this money urgently. Then again, why would you park short-term funds in the stock market? Lastly, on the part of accumulating shares, some may wonder why are we buying shares now if we are of the view that the market is going to continue to go down? Why not wait a little more? The answers are simple. What if we are wrong about the bearish market? And what if we cannot pick the exact bottom? So in my view, as long-term investors, we are not in the business of predicting where is the market bottom. Our aim should be try to capture good opportunities in uncertain times or bear markets like now, where stocks are relatively cheap. At the end of the day, the ultimate goal is to improve our rate of investment return in the long run. And maybe just one question for viewers to think about. Would you prefer buying into the stock market at higher prices when it is on its way up? Or would you rather dip your toes into the market at lower prices when it is on its way down? Alright, that's all for this video. Let me know your views about the current stock market in the comment section below. And if you think my video value add to your research, please help to hit the like and subscribe buttons. This will keep me going. Thank you.